In this video, guys, we're going to have a look at why do stocks sometimes spike after hours. Stay tuned. Hey traders, warm welcome to you. So if you ever wondered why stocks sometimes spike after hours, this quick video we're going to explain why and how it all works. So basically, we're going to stick with the US exchanges for now, because the exchanges around the world, they all operate very, very differently. However, the US exchanges are open from 9:30 until 4 p.m. But we have what's called a pre-market session and a post-market session, which generally is defined as after hours. Now, some people say after hours should be only after the close, but generally speaking, any time that you're allowed to trade that's not an official opening time of the underlying exchange, New York Stock Exchange, NASDAQ, is considered as after hours. So how does it work and why do stocks sometimes spike during this time period? So during the RTH, or regular trading hours, which is, as we said, 9:30 till 4 p.m. Loads of liquidity, options markets are open, all the markets are open, it's full steam ahead, everything is chugging along and there's loads of volume. When the bell goes, if you like, or the closing bell goes, or the closing time hits, that's it. Now we also then have a few ECNs which are open and available for people to trade on. So that effectively means you can still trade. However, the liquidity is far less because there's far fewer participants involved in it. The spreads can be wider. Again, liquidity and spreads come down to the number of participants. The more participants we've got, the tighter the spread, the bigger liquidity. And so you have this pre or post-market time after the close from 4 o'clock to 8 o'clock, NASDAQ and NYSE, where a variety of stocks you can trade them still. So you're trading them via the ECN and you have the ability to place an order. And then if you think about the pre-market 7 a.m. till 9:30 a.m. on the NYSE, 4 a.m. till 9:30 a.m. on the NASDAQ, so you can trade those stocks for quite a long time before the open. So that's fine. So now we understand why we can trade, or how we can trade. We can still trade. Liquidity is less, volume's less, spreads are less. That's important, that, because why do stocks spike? Well, stocks will generally spike because often there is news released after the market is closed. So one example could be they release an earnings report. So there's an earnings report scheduled regularly as part of being a public company. They have to inform the shareholders and the public what their earnings are. So there's a massive report, there's a conference call, all sorts of stuff. Forget about the details of it. The point is that fresh information can revalue a stock in the eyes of investors. So let's say they come out and they say, hey, we're doing very, very well. We've earned far more, we've made far more money than we expected. And our prediction is, we're going to make much, much more. And we've won this court case and we've just hired the greatest new CEO ever, or whatever it is. That's going to be super bullish. And so the stock would spike after hours because many people would capitalize or look to capitalize on the opportunity by buying this in the after hours market. So the stock would spike. And don't forget, we have made the point, liquidity is less, volume's less, so the same person executing the same trade during regular trading hours will probably not impact the market much at all. Whereas after hours, because the liquidity is less, it takes far less volume, if you like, on less number of shares to move the price much more. And so that's where you get these spikes. You get this fresh news coming in that reprices or revalues the asset, the stock, in the eyes of the investor. They then go in and make some trades based on that. Because the liquidity, market depth very thin, that's when we get these kind of price spikes. And similarly vice versa, of course, if there's bad news coming out, again, it doesn't necessarily have to be earnings, it could just be some kind of news. Let's say it was some global news where there was some sort of incident where there's a contamination, let's say in some sort of food supply chain or something. And so companies that were involved in food processing may well get hit after hours. But the score, there's plenty of different iterations of news and things that can hit a company adversely or hit a company positively. And because the liquidity is low, because the market's thin effectively, that's when we get these spikes. And also don't forget, might not necessarily be a catalyst. There might just be, hey, literally someone wants to get in and out of a trade for whatever reason, and we come back to that same point. Liquidity is much lower, volume's much lower, and so it takes less volume from a group of traders or one trader or one institution to move the market more. And so that's why you get these price spikes after hours. All right, guys, take care. See you next one. Bye-bye.